Hello and welcome to our daily Forex market review. My name, of course, is Derek Schimming with the new Trading FX. This review is for Monday, January 28th. Now, I'm sure most of you realize that the market has really come into its own so far this year. Now, typically that is the case, or I should say historically it is the case. We get into the new year, we come off the slowest time of the year, and we enter the prime 6-7 months of the trading year, the first half of the year, if you will. Of course, that was not the case in 2012, so it's refreshing to see us start 2013 so well. And when I say starting so well, what do I mean? It's really the three primary components that as traders we're looking for. Number one is increased trading ranges. The average daily trading range for most of the substantial pairs, the major pairs if you will, has more than doubled from a year ago. That's a very good opportunity for us as traders. Secondly, the trends have been lasting for multiple days. Again, this is something we really did not experience in 2012, at least not the last half of the year. That really became almost just a scalper's market because we were up and down with very little multiple day trending opportunities and a very choppy, volatile market, if you will, with a pretty tight trading range, some sub 100 pips average per day. Makes it very difficult for us as traders. And that's just not been the case so far this year. It's been just the opposite. We're trending. And the third is the fact that the technical setups and entry indications, I think, have just been as clear as could be. I think we've had some tremendous opportunities. Now, maybe more so when you're using my professional charting, which I can make available to you very simplistically at the end of this video and on the web. So I want to look at something specifically. And the two things, and where I really want to start, is our CCYX. Now, this is the Currency Strength Index, and some of you are already aware of what this is, and if you're not, you sure as heck should be. Because the CCYX, what it does is it disassembles the major pairs. It isolates the individual currencies. It's looking and drawing its data from the largest liquidity pool in the world, looking at transactions done electronically from over 70 global banks and brokers. What this does is isolate the individual currencies and show you their strength and or weakness as opposed to the other currencies. What this does is allow you to hunt for and identify the better trending and better trading opportunities, and then ultimately place trades where both currencies are moving in the desired direction of your trade. If you go to the top left-hand corner, you can see what each currency color identification is. The pound is pink. We like the Queen. She wears pink a lot, so we put the pound in pink. The dollar at the top of the scale is in green for the greenback. Obviously, we had a little fun with this. Swiss is in the middle. They're in white. They're neutral, so we used white for the Swiss, and so on. So there is a color coding for each currency pair. A little bit of fun with some of them. Others were just colors that were available. But I do want you to notice the pound, which is trending down and is the most negative trending currency so far to start the week. On the opposite side of the spectrum is the dollar and the yen. Now, this is unusual for the dollar because the dollar, as you know, has been lifeless so far this year. Largely, in fact, that might be the fiscal cliff issue and the debt ceiling issues that we're dealing with the tail end of that the last year and currently in the States. Or maybe it's just the porous U.S. economy. We had the elections. There's so many things happening here in the States that have negatively affected the dollar. Now, has it negatively affected the dollar and the fact that the dollar is trading down? When I say negatively affected the dollar just hasn't been trading. It started off the week well, so we'll be optimistic and hope that the dollar can come to its own again. However, so far this year, the yen's been the standout. And typically, the dollar and the yen are your two most correlated currencies. They typically move together. So largely only the reason that I don't ever trade the dollar-yen pair. But the yen pairs have been very attractive. And if you look at specifically the pound yen, the euro yen, and the Swiss yen, not only have they been the best trading opportunities and the best trending opportunities, but they also have the greatest average daily trading range. Again, key for us as traders. So if you look at this chart, and because of what's happened the last few weeks, I again would suggest that the yen pairs are where I have been placing my focus, and would strongly suggest that you do the same until conditions change. As traders, we are chameleons. We're going to adjust ourselves based on the current market environment. And this current market environment says, look at the yen pairs. And again, specifically, pound yen, euro yen, Swiss yen have been the three standouts in my opinion. So let's look at that a little bit more detailed. Let's minimize the currency strength index, and let's go to a couple charts that I've set up for us to do this review. Now, this is stepping back and looking at the pound yen. I want to do a step back view so I can build the case of what we're seeing and why we're seeing it. This is going back to the start of November, so this is basically a 3-month look back at the pound yen pair. I've taken the liberty to draw a support and resistance line and the trend line, and you can see that for the tail end of last year we had the pound yen driving up strong. However, you'll also notice that when we got into January, it looks like it might have run its course. It has at least found some resistance, and you can see that resistance line that I've placed is just over 144. It's about 144.30, 144.40 range. And then the support, when it pulled back and it came down to these support levels, this was in the first week of January, and this is just last week. So we also have a support line drawn right above 139. So that is the range confine that we find the pound in currently, and why I find it very intriguing. Notice that this is the third time it's been up to that resistance range. It's the same area that set the swing high last week. So let's look at this. Let's modify this and let's zoom in a little bit and go look at last week's swing high in relation to where we are so far to start this week. And I think that you'll see, again, with the yen pairs making the best overall move in the market, I think that you will see that there is an increased, or what I would call an above average opportunity to trade the pound yen currently. And this is where I have focused my attention so far today. This is looking at the swing high last week. You can see at the far left end of the hand side of this chart, and then the far right hand side is the swing high that was set as we started this week. I've again placed the resistance lines on the chart, both and the support line, right at 144.30 and just above 139, about 139.20. Typically the yen pairs drag their heels at 20 anyway, so I think it's appropriate to mark that at 139.20. So you can see that the pair has set itself up and is trading down from what I see as a resistance line. And that resistance line in that resistance range seems like it's pretty solid for now at least. Now I would change my opinion if the pair was to get over 144 and trade above that high range that it's been at over the last few weeks. And if it was to come down and show me that this same level would be support, obviously, when we trade through resistance, it becomes support. When we trade through support, it becomes resistance. So if the pair would prove to me otherwise, then we could look at the trade long. But I really personally would not be interested in taking the long trade until I saw it over 144. Now, I change my mind if we're down at 139 and we're trading up again because of the range, but that's a different conversation and a different session for that matter. So I'm building the case of why I'm looking at pound yen today short, and I do believe that pound yen short is the best trade on the day, and that's exactly the trades I've placed. So let's go look at today's chart, and I'll bring this down to a tighter study, and I think that the clarity difference that I'm offering on my charts helps every trader identify the opportunities in the market, not only in a noise-free charting environment, but you're strongly going to see, or most likely going to see, an earlier indication. Sometimes that can be just a few minutes. In other cases, that may be much more than just a few minute time frame. So, but clearly you can see that this support and resistance range has identified itself, and I think creating an above average opportunity for us as traders. So let's look at today's activity. Now this has the pivots on it, and you can see that as the day started, this is the start of the week, and remember, we're coming off that high just over that 144 range. So as the pair traded down, the week started, I wasn't really active in looking at the market as the market opened, but as we get closer and closer to the London time frame, another really great thing about the market is we've had more days where trading is available at multiple times and not just isolated towards, say, the New York session or so. The London market's been attractive. The New York time frame, the overlap hours have been attractive, and the Asian markets, even during the Aussie and Tokyo overlaps, have been attractive. Now, my first trade was instigated and called in the trade room for others to identify and follow and become a part of right here as it came below the pivot range. I took that first trade on this bar right here, this particular, let me put the crosshair on it, that bar I've indicated with price. It came down as it broke below the pivot, which is at 143.34. I actually took the trade at 140. What I said 143. 140. Yeah, 143.34. So as the trade came below the 143.34 range, I actually instigated the trade at 35. So that was a short trade on the red bar that I've got identified by price as it's crossing through that pivot range. Now, as it traded down fairly quickly, and you can see that initial move down gave me the opportunity to walk away from 40% of the trade with the desire to enter our swing position. Remember, when you have an opportunity and the market is giving you a chance to identify or what you anticipate may be the top or bottom of any move, you should have the desire to put yourself in a swing position. Swing position and manage the swing position. Remember, swing trade is not taken just because you have a bigger stop. A swing trade should be earned based on profitability of a shorter term trade. So what we do is scale out, or what we call punch out of a portion of the trade. So I did. I walked away from a portion of the trade when it made that initial move down in this first stopping zone where it kind of found some support, and I didn't get the bottom by any means, but was able to walk away from part of this trade when it came below the figure at 89. So walking away, I got a 46 pips. I'm moving my stop to a break-even line, staying with the trade with an objective to see more. As it traded down later on and it came down to S1, it looked like pretty good. It made a quick move down to S1. Looked like there was going to be a lot more, but I did not want to get greedy. It made too sharp of a move, and I felt because of the pivot point and the time of day, it would be ideal to exit that trade. So the 60% portion, even though my desire was to end up with some portion staying on for the swing, I did in fact elect in the trade room to close the position at plus 85. That was at 142.50, excuse me. So that nets out about 69 pips, 65 if you're just doing the two combined, but it was a 40-60 split, so it really comes down to almost 70 pips for that first trade. Then we come into the New York time frame, and we did the same review live in the trade room, and so the traders were prepared for and looking at the market as it was doing this exact same setup today. So the second trade was entered when it crossed our entry indication on the bar, this red bar, when it came below my integrated average range indicated on this chart. Also, right, if I get my cursor on there, right at that point where the red bar crosses the integrated range in my D lines, which is a template setup specific to my charting system and something that's built into the system for you to utilize if you're one of our chart users. So this trade was taken at 142, and I let it break the figure this time, 142.98. It's just below the figure. I was telling the traders we want to see it break below the figure before we take this trade, and this is where the trade was instigated. So it went up a little bit. You see this wick. That trade, where the trade was against me, I believe it was 11 pips at one time, or maybe 11 or 12 pips, something like that. You can see that little wick right there really was kind of making me nervous because, like, gosh, it's got to stay under the figures. Things got to get under the figure, which ultimately it did. So as it made its first move down, I wanted, again, we've got to get this thing to a risk-free situation. So when it dropped to 77, took 40% of the trade off at plus 21. Move the stop to a +1 situation. I'm in a zero risk trade. I've got money made. The prior trade starting the week off pretty well. As it came down here just about an hour ago, I elected to, again, Pretty much the same exit as before, 142.52. Before it was 142.50. This time it was at 52. Same range, same reason. S1's there. It's shown it had support. It bounced off of S1 once. It bounced off S1 twice. It bounced off of there. Well, it violated a little bit, showing the desire to go through, but it got itself back above. And so, you see this, you think, guess what? There's buyers there. There's support there. I'm not going to fight that. So I took off 40% of the trade. I am holding a 20% portion. But that 40%, that 52, that gives me another 46 pips. So far this trade has averaged 34 pips. I'm over 100 pips on the day. I have a 20% portion of this trade riding. I have the limit order. I use an OCO. One cancels the other. I've got the stop in at plus 20. And I'm going to move that to plus 30 here when we're done with this video. And I've got the limit at 05. So the limit gives me the opportunity to bank another 93 pips on a small portion of the trade and really enhance the return for the day. But that's how I see it, and that's how I'm trading it, and that's what we're doing on our trade room. And for those that are part of it, you know what we're doing, you know why we're doing it, and you know why this review is being done. For those who aren't part of my firm and aren't trading with me on a daily basis, you have that opportunity. It's very simple. Send an email request to DerekSchimming@gmail.com. Trade with a market veteran who has over 25 years of experience. I'm a professional trader that has a desire to help you. And it's a very simple opportunity for you to come in and sit with us on a daily basis and use and learn these simple, proven techniques using very little indicators, focusing on the thing that matters, price. We look at pure price movements, and my charts are the only charts in the world that were built ground up with time removed from the charting element. The only thing we use time for is a reference piece. It has nothing to do with our trades. I can teach you some very simple trading methods and some trading techniques, and I want to have the opportunity to do so. If you have an interest, send us an email. Derek Schimming, DerekSchimming@gmail.com for your free invite into our trade room. I'm Derek Schimming. You guys have a great day trading. I'll see you on the floor.